All right, so I think we'll begin. We've got a good number. Thank you very much for joining. I'll be flying solo today. My name is Norbert Gehrke, the founder and representative director of Tokyo FinTech. And you might actually have registered for this session through either Tokyo FinTech, Seoul FinTech, or Berlin FinTech. So wherever you are, welcome to this session, and I hope we have a good discussion. As I'm flying solo, I will try to take a look at the Q&A while I'll speak. Given my old age, I will need to use the glasses to read the questions, but if you have any while I go through the material, please do not hesitate to key them in. Rather try to address them immediately or after I'm finished. This is about, I would say 30, 40-minute presentation, so we have enough time for discussion afterwards as well. Just for context, so this presentation actually given last week to Global Federation of Service Providers, which arguably you can call legacy service providers. So it's been businesses that have been around for quite a while that also happen to have a payment infrastructure that they have refreshed over the last 3 or 4 years and actually would like to market a bit further. Given the timing of the presentation was in the European afternoon, the expectation was that the participants will be largely coming from Europe, the Middle East, and Africa. So that shaped a bit the examples that I'm using here, although they're not limited to that geography, but also gives you a sense that obviously it's a diverse range of participants from fairly developed to still developing countries with various degrees of existing payment infrastructure. I think given the legacy nature of that business, there's a bit of the fear that they've always get beaten up a bit and say, right, you will be bankrupt anyway in 5 or 10 years. Why should anybody care? So explicitly try to avoid the negative bias here in this presentation. If you look at it from a SWOT analysis perspective, really talk about more of the opportunities and the strengths than the threats or the weaknesses. So what we're going to go through here today is a brief discussion of the hypothesis, which is very much what is in the subtitle to this presentation, and then actually look at the function of providing payments from different perspectives. So from a payments pure play startup, from a general startup perspective, because it's becoming more and more important if you look at it from a venture capital perspective, for example, for investments. Obviously, payments as a platforms and certain examples there, then the role that banks or new banks are playing across the board, and also a brief discussion on open banking, although that obviously is also a topic in its own right that could take a whole hour. I think we have 2 very interesting examples of government policy and government action shaping the industry, and we're going through those. And if we still have time, there are some further considerations of things that we've seen that might be of interest. The most interesting part of all of this, I think, is that quite a few of the items that we have here, we've been talking about for a long time, let's say 2+ years. And the news flow was such over the last months that you feel, wow, it's finally coming to fruition. And lots of the things that have been in progress are now becoming real. And so that's certainly interesting as well. What I told the audience a week ago is that if I had more than 1 hour for the presentation, first of all, I could probably talk about payments in 4 hours. But if you had 4 hours and you wanted to structure some kind of curriculum, payments would be one component of that. And leading from that, you would discuss blockchain distributed ledger technology. In another session, combining these two into discussion of cryptocurrencies, and then leading to central bank digital currencies. And from this outline, you also see that we're probably not going to touch too much on crypto and CBDCs in this session. That wasn't the intent, although some of the examples clearly go in that direction. So the hypothesis we're working on is that the marginal cost of all digital transactions is converging to zero. And that obviously is good for the consumer, and it might come as a little bit surprise when we're saying essentially payments will be free, but there's a long history of examples that leads us towards that, right? Clearly, if you go back 25, 30 years, we all were very happy. If you're old enough to remember the AOL connection and the "you got mail" kind of jingle, then the volume of communication that went through snail mail was so much larger than electronic mail. And obviously today it's totally the other way around. And if you're happy enough to get a true letter once in a while, that's an exception and it's a fantastic feeling. But all communication is basically electronic and digitized. And so the cost of that is zero. If you ignore the subscription, that is your internet service provider. Same obviously happened to voice. Once you digitize voice, then it becomes just data that gets transmitted through the same pipes as your email. And I remember well in the late 90s making calls to Asia from Europe at a cost of $3+ per minute. And now obviously even on Zoom today, not only voice, but also the video conferencing ability, again, is largely free. Stock trading, right, which is of course one of the items that has been in the news over the last 4 weeks with Robinhood, who started the drive towards free, quote unquote, stock trading in the US, where they changed the whole industry. And by the end of last year, all the major discount brokers offering free stock trading, not necessarily option trading, and it depends on the broker you're looking at. But it's free. 8 Securities in Hong Kong, which got acquired by SoFi, has been pioneering that in Asia. And in Japan, SBI Securities is offering that as well. And clearly, it's a problem for incumbents like Nomura, who also depend on a physical distribution network with branches where the commission income is a significant part still of the revenue. So it raises the question, right? If anybody wants to argue why payment should be any different, and it's no different than making a ledger entry for a stock transaction. It's no different than sending an email. And maybe the surprising fact is that clearly Google tried it much earlier to attach payments to an email, and it never really took off. Simply, so the use case is not necessarily that you start with an email and send somebody money, right? The context is much more social maybe, or driven by a payment transaction. It doesn't start necessarily with the email. But from a technical perspective, there's actually no different, not much more complicated to send a payment than to send any other digital information. And hence the thesis that payments will go down to zero. Naturally, then, if you are in the business of payments, the question is, how do you make money? And there are different answers to that. So the first one is clearly that, and that happens in some industries, right, where your core business might be somebody else's customer acquisition cost, which is a bit of a problem, because if you view payments as a customer acquisition cost, you don't necessarily need to make money with it. It's just a replacement for advertisements, marketing, etc. spent. And so I think that's what we see a lot with the fintech companies today that start off in payments. It's relatively easy to build nowadays. And ultimately, it's a way to get people onto the platform with the promise to the investors that ultimately you will monetize. Whether that actually happens, or it's like this picture where still the customer acquisition cost is much larger than the lifetime value of the customer, and hence the monetization overall, that remains to be seen. Some cases clearly will be successful, some others won't. And we've seen, especially in Australia, right, since the beginning of the year, we've seen one neobank fold, and we've seen another one being acquired by NAB. So you can see this as a good exit, bad exit type of scenario, and maybe the long-term viability, especially in a limited market in size like Australia, wasn't necessarily there for a neobank that's started on the payment side. And we'll talk about alternative approaches later there as well. The second way of monetizing the experience is to provide a tiered model and provide subscriptions to a certain extent. That's clearly what Revolut has been doing. So you can get the premium Revolut account and you get a Metal credit card. Wow. People who know me know that I'm probably a bit skeptical in that regard, simply because the Metal credit card doesn't change the function of what it's doing, and it's not really innovative. But well, they're doing well with this and it sells. So what do I have to say? They clearly made money with this. They have longevity in the customer relationship, and it's being copied widely as a model. So you can charge $5, £5, $10 or so for these extra services, and you get higher limits on ATM with withdrawals and all these things. The third model here, in a way similar, it's a subscription, is the Swedish payment systems. And it's 6 Swedish banks that put themselves together starting in 2012 to build the Swish system. And if you have friends in the Nordics, they will tell you that many of them haven't touched cash really for a transaction in years. So they typically get provided Swish for free. Some might have also a monthly subscription on it, but mostly I understand it's free. And ultimately, the entity that receives payments, so if you pay your electricity bill, etc., then the corporates are actually paying for that on a transaction basis, and they might pay an annual subscription fee to be part of that service as well. I think swishing become a verb in Swedish, whichever way it is pronounced, and so they've been hugely successful, and clearly Sweden is far, far ahead of the curve in terms of cashless payments and cashless transactions, with around 95% cashless transaction on the consumer side. And so that throws up totally different issues that are not part of this discussion, but when it comes to financial inclusion and the possible exclusion of others who are not digitally connected, and there's still a minority in our societies. So this was space for questions. As we don't have any popping up right now, I'll just continue. So the second part of this presentation focuses on the definition of what is actually a payments company. And if you want to look at it in a little more detail, then maybe what is a payment function, or how can you shape it? Because like the audience for this presentation, you might actually have a payment function embedded somewhere in your organization that might not be your primary business, but you can shape things around that. So the question of what is a fintech, what is a payments company, is becoming a bit blurry, and hence this picture, of course, a little bit of a cynical view with Wirecard here. So the German regulators apparently have some issues identifying what is a payments company as well. So a little jab there. So as I mentioned in the introduction, not necessarily in this order, but want to look at a sequence of examples here to illustrate how payments are being used and what different qualities there are when embedding them in a business or running it as a primary business. And clearly there's the banking world, where payments have always been a key component. If you look at the Asian banking market, for example, then depending on the country, you're looking at somewhere between 40 and 70% of the revenue of the banks will actually come from payment flow. Now, not all of that is retail. Clearly, there's a good chunk of corporate payments in this as well. And the corporate payments are much more protected because there's a whole ecosystem of financing solutions, etc., built around it. And if you look at it from a fintech perspective, I think 2021 actually will be the year where we see the first fintechs taking a serious bite at that pie. But the likes of Citi, JP Morgan, and now also Goldman Sachs certainly have built the infrastructure and are pretty much embedded in that space. So everything we're talking about here is much more focused on the retail and the consumer space. Right, and then we have the whole startup space in different flavors. We obviously have pure payments, fintech, banking startups. We have startups that provide payments as a service, as a platform. And then we see generally startups that serve an industry vertical, for example, using payments as an additional revenue source. And that's a very interesting use case. So let's go through some of those. Before we do this, of course, the brackets around this, right? It wouldn't work without national payment system as the underlying infrastructure. And then depending on the regulation you're in, you've got open banking regulation on top, very often enforced by the regulators, and sometimes simply with slight nudges. So it depends on whether that's industry-led or regulator-led is maybe one differentiation. But even that is blurry because it might be that the regulator is saying, well, you can do it by yourself, and if you don't do it, then we force you. So is that now industry-led or not is a good question. But so start with the startups. That makes sense. So clearly what we've seen now almost over 2 decades in the retail payment space, and it started with the peer-to-peer payments. This takes us back to Elon Musk around, was that 2000, 2002 with PayPal. Right? That's where peer-to-peer payments started, and it was a good start. If you do a payment startup, you clearly are still using that as your first base, but it's far from enough these days. So the bar has been raised tremendously, and you need to continue innovating and provide new functions. The second, maybe somewhat surprising, at least for me, a compelling use case is the bill split functionality. So that made certain apps very popular. I think this is also maybe a bit US driven, right? When you share a meal and you tip and they only take one credit card or so, one person pays and then they split the bill through the peer-to-peer payments application. Again, it's table stakes now. It's nothing interesting. The third one is becoming a bit old now, although maybe 2 years ago this would have been super hot. Is what is referred to as a personal financial manager, or PFM. And so that's a consolidation, ideally also using open banking in the background, consolidating all your accounts, giving you consolidated picture of your finances, being able to categorize your spending, doing planning, right? Showing your spending patterns and all of this. And really good. There's some good applications that have been built in this space. Now, the picture here is a picture that comes from Tink, which is a Swedish payments company, and they give you a software development kit and SDK with all the components that you need to build a PFM. And for a skilled software engineer, it takes you probably about 30 minutes to spin up a very basic version of a PFM. And then you can do all the funky stuff, the extra functionality and the colors and the branding around that. But imagine that. So if you wanted to build a PFM, the tools are there now as SDK, as prepackaged software, to allow you to do this in a very limited time. So again, the barriers to entry for this market are just tremendously low. So next one, this is new, maybe not so new, I don't know. TransferWise also has clearly been Revolut's claim to fame is to have a multi-currency account. So you can actually have an account and you get bank numbers, IBANs, international bank identification numbers for your accounts in different currencies, and you can typically at a mid-rate or near mid-rate convert between these accounts. So in the pre-COVID world where we're all traveling and maybe some people don't have a home anymore, are the modern day nomads who are living 3 months here, 2 months there. It's very convenient to have that. And it's probably table stakes now. And many of the startups who are doing this, again, using a service provider on the back end, that's Currency Cloud, which has been the first one, I think, to build this. And they provide all the functionality and licensing, etc. The bigger ones clearly become payment providers and licensed payment providers in their own right in the different jurisdictions. So then we have the big elephant in the room. Clearly one is Square, which is already listed. And then there's Stripe, which I see in the Western press always described as the largest or the highest valued private startup, if you can still a $36 billion valuation in the last funding round, the startup. And they don't seem to have any intention of going public. So the latest articles on that topic talking about aiming for $100 billion valuation before even considering an IPO. It's a very Western view. I think the Ant Group, previously Ant Financial IPO that got canceled at the end of last year, was aiming for 200 billion plus, given the subscription that came in for that. And then Ant is a different topic given the current situation. So we have Stripe certainly as a highest valued FinTech, privately held FinTech, very successful, and people in the industry think it's the best in terms of accommodating startups. It has been built for startups, clearly has grown with the startups, and kept ahead of the pack so that the startups, as they grew and became successful, didn't see a need to leave the platform, which is a key, right? Often the service providers become a bit stale. They're not growing ahead of their customers. And so at some point then the decision for the strongly developing startup is you're going to leave the service provider and build it yourself. And with Stripe, this hasn't happened, so all the credit to them. Where they did have a blind eye a bit was in Africa geographically. And so they paid a few weeks ago, 200 million US dollars, I believe, for acquiring Paystack, which is now a Stripe company based in Nigeria, if I remember this correctly. And now clearly with the goal of having the Stripe backing, both financially and technically, to roll out across many more African countries. So it will also be interesting to see what that means for the startup ecosystem on that continent as a key enabler. This is important list of all the clients. So you see the illustration of what I just mentioned earlier, that even as the startup's growing, they still stick to Stripe as the payments platform. And I want to draw your attention to the top here with Shopify. It's a great example to illustrate what payments revenue can mean for a startup. So this is a chart of the Shopify share price and the percentage of the revenue that actually is associated with payments. So what you see here clearly is, right, we're going to, I said, 70 to 80% of their revenue is payments, and it's all on Stripe. And the share price, I haven't checked it for this presentation. Last week it was somewhere above $1,200 US at this point. So interestingly, the CEO says that if they were to build payment functionality, then they would build something that's very, very similar to Stripe. But in order to do that, they need to refocus and create a whole engineering team around payments and essentially maybe lose attention to what to some extent is a core business, being these e-commerce platform. Although you can have a discussion here clearly around, well, is e-commerce just a vehicle to drive payments on the platform, which generates the revenue and then the growth and the valuation that comes with it, right? So it's probably one of the strongest customer testimonials that's out there in terms of why Stripe is so strong and entrenched in that space. There's even for a company as large and with the transaction volume as big as Shopify, is no incentive to actually leave them at this point. And to some extent, you can ask a similar question probably about other companies, right? Even Amazon. So given the success and the margins that they have on Amazon Web Services, is Amazon e-commerce company is like the e-commerce just a sliver on top that drives usage of all the logistics, of the delivery of the Amazon Web Services pie, was ultimately probably not making that much money on the e-commerce still 20 years after founding. So Shopify is fine. You saying, well, this is obviously a very large example. What about if it's smaller? And so there's a number of companies, and Phoenix is only one. So I picked one example here. Don't mean to say that's the only one. Who are providing startups, especially when they are in a vertical industry sector. So let's say you provide software to run gyms, right, or restaurants for this matters, or yoga studios, and all these different things. If you're the software provider for such an industry and you've got about 50 million in payments running through your platform, there's actually a good case for you to take those payments in-house. And right, never mind the Shopify experience of having grown so much, so fast, so big, without leaving Stripe. I'm certainly they've negotiated a better deal, but if you're a tiny, small startup, then the fees that you pay Stripe are not insignificant. At least you get some revenue, which is great, which adds to your bottom line. But rather than investing again in a technology team, building out the technology, building the payment stack, which ultimately could cost you $1.5 million or so in 12 to 18 months to get it off the ground, you can again buy components from a company like Phoenix that allows you to take these functions in-house, have the revenue drop pretty nicely to your bottom line because the cost simply isn't as high as building out your own team. And if you're a software company that serves such a vertical and it's not part of your business plan, then at this point you would get questions from your VC simply because you're leaving money on the table. So in 2020, I think it has become somewhat table stakes to say we must make this part of our proposition to show growth and to become self-funding much sooner. And if you ignore the payment side, then you need to be very, very good on your core business. So that's a bit the startup world. And now we can take a quick look at the new and the old world of banking. So we've got the stodgy old banks depicted here, and then we've got the neobanks. And I alluded to that a bit earlier in a sense that when you look at European neobanks, for example, they've been largely founded out of the payments experience. You've got payments, you've got bank accounts, all of that is free, right? Which also invites some and maybe not enough criticism. Is why would you build an industry around providing and giving your services out for free? N26 here, one of the like top 5 European fintech companies, I'd say, and neobank, very successful in that regard in terms of their valuation and the customers that they have, but still out of that experience, because it's free, it's easy for people to try. The primary usage is as a secondary account. So most people still have their primary accounts, meaning the accounts where they get their salary, the wages transferred into in a traditional institution. They opened another account on the app because it's nice to play around with. You put some money in, but the balances that are held in these accounts are tend to be quite low still, say around 500 euros or so, which will be different if it's a primary account. The difference here to some of the things that are happening in Middle and South America, and Klar is a Mexican neobank that our friends at Mauro Capital, which used to be Santander Ventures, and we had Manuel Silva Martinez speaking at our Tokyo FinTech meetup, probably now about 18 months ago when he was in Tokyo. And so they invested in Klar, and Manuel stresses that this is a loans first neobank. So they're serving the need of the unbanked, underbanked population, access to maybe smaller loans for the consumer. And that is the primary business. So they're not coming from the payments angle. And I find it interesting, at least on the surface, you see these global maps of neobanks that clearly there are differences, regional differences in how these businesses start up and where they find their initial niche and then hopefully growing out of them. this is now a slide specifically for the audience that we had last week. So if you look at Eastern Europe, for example, and also the bridge to Asia, you see actually quite a number of very successful digital banks or banks that have transformed themselves to be digital. So Tinkoff is the third largest bank in Russia these days. It actually came out of the card experience, and by the global financial crisis 2008 had to do more things to survive. And now they are a full service bank. They're the only fully digital bank without any branches, and have expanded into a full platform organically. So they've built all additional services by themselves, while some of their competition, they've acquired and tucked in functions. So Tinkoff is a brilliant example, and their market share is tremendous. It's like over 10 million customers. So somewhere around 12 to 15% market share in Russia, I would say. Moneta is a bank in the Czech Republic that transformed very successfully into a digital operation, and AK Bank in Turkey. So you see some of these examples, right, in the wider European space, not necessarily in the Central European, the core countries. So there are very interesting use cases. If you're looking at digital banking leaders, then these three institutions clearly are worth a look. Now, to round this out, we always have the discussion around FinTech and TechFin and what happens if big tech actually gets into the game. So we've seen some of that and discussed it in previous Tokyo FinTech meetups. Now you see two interesting tie-ups for sure. One is that Google started working with Citi, who also, I would say pretty early for such an institution, started to essentially build a parallel neo-banking stack. And I remember the CEO talking about this probably around 2014, 15, I would say, and said that it's way too difficult to transform the existing stack. So we're building a new one, and they had a team out in Queens in New York City focusing on that. That team certainly has grown by now much further. And at some point, we'll figure out how these two merge together, or we transfer the old one onto the new, whatever might happen. But again, they were pretty advanced in their thinking, I would say, as to how to innovate themselves. And now Google is basically using their infrastructure to provide current accounts in the US and probably much more than that. The second example, of course, is Apple Card together with Goldman. So Goldman has Marcus, which is a retail offering, consumer offering that is built on top of GS Bank USA, which was created while I was employed at Goldman during the financial crisis of 2008, when Goldman became a Fed-regulated bank and no longer a broker-dealer, on one Sunday afternoon during the crisis, together with Morgan Stanley. And so you see now the partnership there, and you see Goldman basically offering retail products directly, but also doing banking as a service, so to allow startups or anybody essentially to rent out the functionality. So there are a few words on open banking, which has different regulations across the various jurisdictions. And we also talked about this in more depth previously. I always become very popular with my insurance friends when I ask them what they're doing about open banking. which seems like a crazy question. But for me, open banking actually introduces an asymmetrical playing field, right? So the banks are obliged to give you access to the account information and possibly also to payments initiation if you're so licensed as a money transfer business. But they don't get anything in return. So if you are any business really, thinks that getting access to your customers' banking history, banking transaction is beneficial, and obviously with your customers' consent, then you could build such an entity and provide an app, right, as a PFM. So if you're an insurance company, you've got all the information on the insurance contracts for your clients, which is probably already much more information than the bank has. You can augment this with banking information, and you have a built-in competitive advantage at this point. We've been talking about this for quite a while. I wrote an article on Medium last year, and the phone started ringing afterwards from some insurance folks say, what do you mean open banking for insurance? But it's also noteworthy that the regulators have woken up to this. The only regulator globally who had taken a holistic approach to this topic has always been Australia, where we have the Consumer Data Rights, CDR, which started with banking, but is from the outset scoped to expand to insurance, to utility providers, to phone companies, etc. So it's truly making that information fully accessible. And quite interestingly, the Financial Services Commission, the FSC in Korea last year put out a short paper for comment that was looking for more equality in open banking. And what they talked about is possibly forcing the e-commerce companies to open up their order history in return for the banks opening up their transaction history. So that would be the equivalent of an Amazon, for example, to open up their order history in the same context, in the same way as banking transaction, which will be very interesting as well. So I think this will see more of that coming also this year, next year. Another example I love, and it follows the theme of, well, if your core business is somebody else's customer acquisition cost, what's that actually mean for your revenue potential? And so the people at Nordigen, which is a Baltic startup that's very much specialized in categorizing transaction data that you get through open banking. And so you can, is it food, is it subscription, is it utilities, are you shopping, right? They help banks do this with a very high success rate rather than every bank building it themselves. So their revenue growth is limited only by how many open banking data consumers there are. The more people, the more offerings there are that using open banking data, the more the demand there will be for their services. And so what they've done, I think only at the beginning of maybe it was the end of 2020, is to say, through European regulation, to start with European regulation under PSD2, we actually offer free access to open banking account information data through the services that we've built. And right, you need to register. You obviously can't resell that service, so you need to be the end consumer as an institution, as a business to do that. But then it's free to you. And so all the companies that made a business out of the open banking access now have a competitor who says, like, we don't care about whether we make money out of this, because for us it's just the customer acquisition cost on getting them on our classification platform. So another very good example, and if you want to experiment, clearly, right, you can start working with them and getting access and try things out. The next example leads us a bit into the role of government. So spent some time in Bahrain in 2019, which was very interesting because over the course of a single year, the National Bank of Bahrain forced the industry to accept and then implement open banking regulation. So there was a 6 months period of working out what the regulation is. There was a very short 4 or 6 week comment period, and then by the middle of 2019, this regulation became effective. And the gentleman here, second from the right, Abdullah Al-Muayyad, is part of the wider ruling family, let's say, and he created a startup, Taraboot Gateway, under his, say, holding company that provides these open banking services together with Token. Is also a very prominent open banking service provider in Europe. So the Middle Eastern market, North African market, given the youth of the population, is a super interesting demographic, of course, for many providers. And it shows that if you have the will, obviously Bahrain is a relatively small country, but if you have the will to force change, then within a year you can actually accomplish that, which is tremendous. So the second but last point looks quickly at the role of governments. The first one is what is referred to as the India stack. And the India stack started with the Aadhaar electronic ID. So every person in India has the Aadhaar ID to identify themselves and their biometrics associated with this. There's actually a website that shows you in real time how many Aadhaar IDs have been issued, how many have been updated, etc. It's quite impressive, especially if you consider it's like about 1.3 billion people on that platform. And they have that electronic ID and it's widely used. While, for example, in Japan, we've got My Number, and the government here will take another step in 2021 to try and popularize this more by also linking it to bank accounts and social benefits, etc. But it's not widely utilized here, and it's only 120 million people, which is a lot, but it's also a lot less than the 1.3 billion in India. With Aadhaar initially, which was started in 2009, there was some limited payment functionality, but the real boost here came with the Unified Payment Interface, UPI, that started around 2014, 2015, and really allows full access to banks and banking transactions. And if you register for that service, you also open a bank account. So it drives a bit financial inclusion, which is a topic that we continue in our second example here. So the big change was that initially, actually, you were charged for the transactions. So once by the payment provider and then by the bank executing the transaction, which also served as a barrier to avoid micropayments. So it didn't make sense to have small payments go through if the fee is larger than the actual payment amount. And that got removed last year, I believe, in 2020, or maybe late 2019. So at that point, basically, the volume started to skyrocket, and you've seen a doubling of the volume since, and basically every month sets new records. Well, what's interesting about that also is that many companies started with their own payment wallets, including Paytm. right? Which is the underlying technology behind PayPay here in Japan as a joint venture. As PayTM is invested by SoftBank, so PayPay here in Japan is a joint venture between SoftBank, Yahoo Japan, and PayTM as a technology. So they have a division that deals with the payment wallets, but UPI really driven the adoption of using the bank account as a primary source, and the use of wallets has declined, as well as the use of debit cards and credit cards, actually, quite interestingly. And so, as a little plug here, we've only released this last week. Obviously, timing with the presentation here was quite opportune. Had a conversation with Mihir Gandhi, who's a partner at PwC and head of payments transformation for PwC in India. He's been in that space basically throughout the last decade and has worked on a number of these projects. So if you want to tune into the Exponential Finance podcast and this episode in particular, you get a very good view into what's going on in that important market today. And they've actually started exporting this whole technology, the India stack. So that means that if you are on UPI, the typical first step, in the same way it worked with WeChat Pay and then Pay, is that if you're an Indian abroad or traveling abroad, then they will accept your Indian payment instruments. And then at some point, this technology will be available domestically as well. The second example here, and that's where it crosses a bit into the blockchain space, is the National Bank of Cambodia, together with Soramitsu, which is a Japanese blockchain startup and an initial contributor also to Hyperledger with their Iroha protocol. They built what is essentially a central bank digital currency. It is blockchain based, but it's all driven through the app. And it takes advantage of the smartphone availability in Cambodia. So you've got a penetration rate of around 150%, meaning 3 phones for 2 people, right? While on the bank account side, you have around 30% or so of the people only have bank accounts. So when you start using the Bacon app, the central bank is not disintermediating the commercial banks, consumer banks. You get to pick which one you open an account with, and you get a bank account then at the same time as you register for the app. So this drives financial inclusion. And again, we've written about this. We've also had Takemiya-san in one of our first podcasts, for example. So there's lots of information about this, and whether there's blockchain behind it or not doesn't matter. But as an implementation, to drive financial inclusion, to drive the adoption of your home currency and not create a parallel currency regime, which clearly throughout its history, Cambodia has suffered quite a bit with US dollar as a parallel currency for a while. Quite an intelligent approach and a very successful rollout so far. So definitely worth a look. And so we're getting to the end of the presentation. There are a few themes that just popped up that I think are very interesting. And again, one is one that we've been talking about quite a bit, and that's the intersection of location, loyalty, and payments. And so there's this company, Pulse ID, who got a deal with Visa now a while ago, when they were here also probably 2 years ago, pre-pandemic. They're working with some Japanese partners as well, obviously with Visa across the region. That technology is now available to all Visa customers. So if you think about getting the geolocation from the mobile phone putting it into the context of a merchant who might want to serve a coupon, right? And you do it in a way that's not completely freaking people out. Right, the simple example is that while you're passing by a Starbucks and you get a voucher or you get Singapore dollar off your Starbucks or whatever it might be. These incentives offered in the context rather than you sitting at home and getting a Starbucks voucher, it can lead to a much higher conversion rate. And so having these three things put together, the payment, the loyalty, and the location, can be extremely powerful. And I think, to credit of the Pulse ID team, they are been driving this quite a bit. There are other examples of companies doing that, so they're not the only one, but worth taking a look at if you're interested in that domain. Then secondly, clearly across Asia, we've seen the advent of the digital banks. So you've seen those in Hong Kong, in Singapore, in Taiwan. You've just seen Malaysia putting out the regulation or the regulatory framework for that, and people can apply, and then there's a decision by the middle of the year, I believe. So in Japan, we don't have this because banking regulation here doesn't require you to have a physical bank branch. So you can, and we do have digital-only banks, but in the other jurisdictions, it's slightly different. I've picked Mox here as an example because they are using Thought Machine as the underlying core banking engine, which is built by ex-Google folks. It's a UK-based company. And from a technical perspective, if applied in a smart way, then it allows you to think differently about products, right? Because even if we look at neobanks today, it's still a continuation of traditional product silos. And the way you can configure Thought Machine is that you can be truly innovative around combining things and maybe paying with a debit card first, but then deciding a day later they should go on your credit card, or the other way around. And then again, tie it in with loyalty points, for example, or other assets that might work together. So I'm quite curious to see what Mox might come up with this year. They clearly had a good launch in Hong Kong last year, and I expect much more from them going forward. And the last one rounds out our title, because we're talking about the branchless future, which was a digital-only bank, but we're also talking about the ATM-less future. And so there's, again, picking an example is Sonnet, which is this picture here, which is a company that turns your mobile phone into an ATM. And that sounds very exciting, but ultimately it's just the reversal of the payments process, right? So rather than you going into a shop and paying with a QR code, you use your QR code to withdraw money from the shop. And any shop can be an ATM in that regard. You don't need physical ATMs anymore. And right on the one side, we're driving cashless, and the pandemic is helping that a bit, that we will have less branches and we will have less ATMs anyway. And then you can apply technology in such a way that actually, right, the ATMs, in the future, you really don't have a use for it anymore. We can talk about lots more of what we've seen across the pandemic with ATMs and the declining usage of that. So as I said also at the beginning, this was meant to give a positive spin and positive examples of what can be done for this specific client. And so what our advice was, very simply, is to think about being a platform, right? Rather than just providing a B2C experience, you widen the field when you think about a B2B2C experience. Obviously, that means your customer is somebody else, right? You're not dealing directly with the end consumer. You're actually, your customer is a developer in another company, and that is a different mindset. But I think the things that we've seen clearly with the platforms like Stripe, like the way Greenfield builds, like the Goldman Sachs banking as a service or transaction banking experience also have been built. It's all with the developer in mind, and so built for the developer. Second one was, well, think about payments just as a component, not as the end all be all. So whether you think about a super app like happens in China, or this combination of location, loyalty, and payments, right? And the third one, without giving away who that actually was, we discussed it with, but if you actually have a physical presence, you have a presence in the offline world, think about how you effectively combine online and offline in the future. And again, post-pandemic, that might accelerate some of the thinking, but it's a good advice anyway. And if you see to some extent what Amazon is doing, creating physical shops, etc., we'll get a bit into that from a fintech perspective, I think ultimately as well. So that was our advice. You can find us everywhere. And I see one question. Tax question. Wow. How is holding a multi-currency account regulated by tax authorities internationally? Well, taxation is interesting and it's complicated. Simply, I can tell you that I had to move money from the US to Japan just recently. I did use TransferWise for that. And the money transfer as such doesn't necessarily create a taxable event, right? And I think in order to be fair, the answer should be talk to your tax advisor about that. In the specific context of my transaction here in Japan, is if that was, for example, money that I had earned outside of Japan but not taxed in Japan yet, and then remitted into Japan, then it does create a taxable event. But if I file already a global tax declaration in Japan, and meaning that money that sits outside has already effectively been taxed here in Japan and it's registered, then it doesn't. And right, so it might be similar. I think without knowing the details, that many of my Indian friends who have been working abroad and returning home, or they face some, I wouldn't say similar, they face some challenges that they discuss where because I'm not familiar with the Indian tax code, I can't exactly follow, but if you then were to bring your money into India, right, does it get taxed or not? But outside of the taxation, clearly KYC happens, right? The KYC rules hold, and you need to always be able to prove the source of your funds. So, for example, and what is this? The Financial Action Task Force (FATF). I think the threshold currently is the equivalent of $10,000 that has to report it to the respective central bank, and you might get questions around that. So in the example that I've given on my personal transfer, if you try it out, for example, and you move, say, the equivalent of $100 from one country to another through TransferWise, it happens instantly, provided that the payment system, right, you're sending it to is a real-time and instant payment system. So I can move money from the US to Japan, $100, and although I have an ACH, an automatic clearing house account on the US side, which means that TransferWise only gets the money 3 days later or so. Ultimately, 10 minutes later, we'll have the money in my Japanese bank account. But it's also because it doesn't require any registrations. If you send more than the threshold, then that gets stopped and requires manual intervention, which typically also means that the fees are higher. So obviously, it's not the payment provider's responsibility to take on your taxation, but it's a responsibility to work on AML, anti-money laundering, and countering terrorism financing, CTF, and these things. So they need to ID you. So hopefully that answers your question to some extent. Another question. Hey, Charles. Thanks. Where do you see the traditional global payment brands Visa in all of this? Just waiting to acquire, or generally threatened? Very good question. Thank you. So I think interesting also that you mentioned Visa. I think actually both Visa and MasterCard have been benefiting tremendously by the FinTech boom, right? And in my personal opinion, clearly, right, there's a wall of money that is looking for deployment, and hence we got all these startups funded. How many of them survive is anybody's guess. But the first step for any FinTech startup is to issue a debit card. Again, it's not tremendously innovative, but it provides them revenue through the interchange fee that they get. And I think Visa and MasterCard tremendously benefit from that. Visa, of course, tried to acquire Plate in the US, which is the equivalent of open banking there. There was a deal that came out in the first week of this year, valued at around close to, but not quite $5 billion US, I think. And given that the US doesn't have open banking regulation, Plate is essentially a screen scraper. So you're paying $5 billion for a screen scraper, which sounds ridiculous, but it's ultimately the whole community ecosystem that you're buying with that, of course. That got shot down by what is this in the US? The Department of Commerce, so the antitrust regulation, because they said that Plate actually could provide services that compete with Visa. So to your point here, I think there are other voices in the market that would look at the IPOs that happened in the FinTech space since the beginning of the year and the valuations that went with that, kind of indicating that the founders of Plate might not have been entirely unhappy not to go through with the sale, because the valuation in an IPO could have been higher than what they got from Visa. So maybe there wasn't the ultimate desire to push that through. So that's directly on that. I think there's maybe not that many companies that on the traditional payment rails can compete with the size and the scope of a Visa and MasterCard, and hence they've been benefiting so much from these FinTech boom. However, you see clearly Swift, for example, with their GPI product going more into the retail space, which feels a bit like maybe more of a technical problem, and again an AML, KYC, CTF type of problem. So dealing with the end consumer, need to have better identification on a large number of customers, but otherwise they have an infrastructure that allows for international transfers, and expanding that from a customer basis to the retail consumer side, right, means just scaling up and being able to do more transactions. So very interested to see how that's developing. I have personally not yet had time to take a deeper dive there, but even over the last month there have been more announcements and more papers published on that. So I think that would be interesting to watch. And clearly everything that gets us into the space of the cryptocurrencies and digital currencies, right? Many of them, if you look at stable coins or even central bank issued digital currencies, which to date, with one exception, have been always at a national level, are a threat to these payment systems. So I think only was this Qatar and Saudi Arabia did an experiment last year, and they did it across their two currencies. And so I think for anything to threaten Visa and MasterCard, you will need something that is universally applicable. And we can open the Pandora's box that China, of course, as well. Right? So clearly, the China central bank is very active in the CBDC space. They will try to expand their payment system through the Belt and Roads Initiative to adjacent countries, where adjacent can be right a wide range, given that they've also signed Italy up, I believe. So allowing commerce under the Belt and Road umbrella through the Chinese system is a clear shot at the dominance of the US dollars. So I think there are geopolitical implications on the one hand. On the other hand, you have not seen globally a world currency, right, like the US dollar now, like the British pounds before the Second World War, that is not freely available or convertible. So I think that's just from a finance perspective, the obstacle that China needs to overcome. And we'll see about this. But it clearly seemed to have the ambition to take a bite at that as well. So I think lots of different factors coming in. So hopefully that answers the question. Also, pretty lengthy answer. I think there's no further question at this point, and we're much over. Thank you for staying with my commentary here. If you liked it, hopefully we'll see you back the next time. We'll do again these on and off, and hopefully then also in an offline environment pretty soon again. Please do take a look at the podcast. Quite a few of the topics that we have covered here today, there's further material out because we had some interesting people talking to us about their businesses. And obviously, if you have any follow-on questions or so, please do reach out to me. So wonderful. Thanks again. Appreciate your time and hopefully see you soon. Thank you. Bye-bye.